Our mission is to bring together the best venture capitalists to compete so you have the insights on how to invest with the best.
All right, what an entrance. Robert, show that title belt, what we're competing for right now. That's the title belt. Robert is who you just connected with at First Republic Bank. Let's bring up the VCs. Erica, Yash, Jenny, and Paul. Welcome to the party. Loaded panel. We have water by your feet. What we're going to do to start off, Jenny's already trying to take that title belt. You could hold it. Try it out. Real deal. Right. So what we're going to do here, before we get to the competition aspect of this, we're going to do a little intros. Erica is a two-time winner, I believe. The two-time winner here. And Erica, why don't you introduce yourself, your fund, thesis. Give it about a minute or two. We'll go down the line, and then we'll get this party started.
All right, thanks, Charlie, and great to see everyone here. Thanks for coming out. Really excited to meet folks. My name's Erica Duignan Minnihan. I am general partner and co-founder of Rain Ventures. We are a $50 million seed stage fund that invests in consumer tech and enterprise software companies. I'm based in New York. My partner's based in Miami. I've been doing venture capital for the last 16 years, and I am thrilled to meet you guys and share some knowledge.
Love that. All right. Yash.
Hey everyone, my name is Yash and I am partner at Surface Ventures. We are also a $50 million pre-seed and seed stage B2B software focused fund. We'll invest as early as pre-product, as late as a couple of million ARR. Feel free to reach out to me at yash@surface.vc if you're building in the space.
All right, Yash. Jenny, New York legend.
All right, I'm starting with a fun fact, which is I was the first tenant in this space. 2015, I moved in. There was nothing here, and we used to skateboard around. And that year, I was the first check into a company called Chainalysis that is now worth $8.6 billion. So it was a lucky year and a lucky space. Now I run a founder community that is pretty active. We're pre-seed. We've invested in 200 companies. We invest broadly, but mostly across money, health, and work as verticals. We write 50 to 250K checks.
All right.
Paul Martino. I get to do one piece of bragging here. I won the first episode ever of this show.
That's right.
Woo!
The pilot.
Well done.
And I was wearing this shirt, so I literally broke it out. So Tyler, I wore that for you. I haven't worn the shirt in like 2 years. But yeah, when these two crazy guys had this idea, they called me up. They're like, "We have this idea. Will you help us?" I was like, "I'm in the venture business. Okay, so how are we going to raise some money for it?" Anyway, we'll get to that later. But my day job, I run Bullpen Capital, and Bullpen invests between seed and A. So you find yourself in a spot where you've raised a couple $1,000,000, and all the Series A people come back in 6 months. That's what we do. We call it Bullpen for that reason. They're the seed funds, like these guys are the starting pitchers. The Kleiners and Sequoias are the closers. We do the rounds in between. We've been at it 12 years. We're on our 6th fund, which is about $150 million. And the weirder it is, the stranger it is, the more you aren't from central casting, the more we probably like you.
All right, so this is how it's going to work. Nadal, if you bring up the Slido, there is a QR code that we are going to be using at the end of every round. Is that the right QR code, Nadal? Yes? Thumbs up? There we go. That's the QR code. If everybody could scan that, that's going to be the Slido. And at the end of round 1, 2, 3, 4, we'll have voting, and the one with the two VCs with the most points or most votes move on to the finals. 3 more questions, 1 winner, 1 title belt, bragging rights forever. All right?
Forever, literally forever.
Forever. Yeah. If Paul wins, we might take that shirt and put it in the rafters. All right?
Right.
Maybe not. Yeah. All right. So let's start off with the first question. First question here. Axos, a business media company, was acquired this week for $500 million. Axos previously raised a total of 57 over 4 rounds. Series C was valued at $250 million. Series D was $430 million. Historically, investing in media companies is tough for VCs. Question is, are there any other verticals that you think are really tough to make money in? This is a sector question, so feel free to tell us why you like to invest in the sector that you are also investing in. I'm going to start off with Erica. You have won last, I think, so you're the defending champ in my mind right now.
Yeah,
All right, go ahead.
defending champ. I love it. So, you'll probably hear this from a lot of VCs. One of the toughest verticals to make money in as an early stage investor is consumer goods, right? And that's why people who are trying to start beverage companies or food products or, anything that has to go through retail have such a hard time raising money. And the main reason for that is that companies that are really capital intensive are very difficult to make money on for early stage investors and even for the later stage investors, right? So what we look for when we're looking for deals and why we invest in enterprise software and consumer tech is that we're looking for companies that have really capital light business models, and we hope that they can get to at least 50 million to 100 million in revenue on 50 million or less in total capital. A lot of these consumer goods companies often consume upwards of $100 million worth of capital, and that dilution makes it really hard for investors to make money. But if you have one of these companies, don't worry, there's still hope for you. I have a friend from business school who sold her makeup brand for over $1 billion in cash, and she probably raised less than $15 million along the way. So it can work out.
That's how you do it. You leave off with a feel-good story, and you come back. Paul, what do you think? Other verticals that are tough to make money, and why you focus on the ones you do?
I'm thrilled I'm across the street from the old App Nexus office. You guys remember that across the street? Brian O'Kelly, I was his TA. And I have a special speech I give to any ad tech CEO who pitches me. Luis works for me, has heard me say this when someone comes in. I literally say, what did you do wrong in your past life that you are an ad tech CEO? And I literally only reserve that speech for that one specific category because everybody hates it, it's really hard, and you have to deal with those agency people. Like seriously, like you did something wrong. Like I know you did something wrong and this is your penance. And so this is the one case where I think the venture people are actually right about how much it sucks.
Yash, what do you think?
I gotta agree with consumer a little bit. As someone who made sunglasses for 7 years in India, it is such a dog shit business. But I will say as an investor, where we focus on where maybe others don't is hospitality, specifically restaurant tech. That has a lot of behemoths in there that are very hard to displace. You have a lot of hyper-local, very small mom-and-pop shops. A GTM's a nightmare. But if you can add a lot of value and get to scale, I think there is potential for outsized outcomes for us as investors. And selfishly, you get in with better valuations on the ground.
Jenny, what are you thinking?
All good answers. All right. How many of us really need our groceries in 15 minutes?
Right.
Let me, hands up. I am so old that I have seen this model, pretty much every 3 years it comes back. So I remember Webvan, I remember all of these crazy companies. And, honestly, I just don't think that that's a pain that we all have. And I just, in 2021, 2020, I had all these smart investors telling me, like, they were so excited by all these companies, which all just shut down this year. So, I like logistics businesses, and we actually focus on a lot. So a lot of moving parts, okay. But you need to figure out a business model, and margins are really important. Unit economics are really important. And then real, customer desire. It's nice to get groceries quick, but do we actually need it? So we focus on businesses that are really solving a critical pain point. So we do things in healthcare and in fintech. And I think you just have to be careful of these kind of fly-by-night models.
If I had to guess, I'd estimate over $50 billion has been invested in 15-minute or
really
less
smart people, people that I respect,
Sadly.
great investors. And it's every 3 years they're pitching me on this, and I'm like, I have seen this movie before, and it really sucks. So.
Okay. Let's open up the Slido, the voting. Do you while the votes are going in right now, everybody's going to be voting. Is there any disagreements from what has been said here? The banter is the good part. I
want to add a little bit to the 15-minute delivery, if I can.
Did you invest in one?
No, I did not. I absolutely did not. But I do think that model can work really well in emerging markets. Not so much in developed countries, but Zepto is a good example. I'm from India.
Because labor is cheap?
Because labor is a lot cheaper, and the margins are better.
Look, I agreed with Jenny forever. But then this guy, Semel Shah, was in my office, and he said he invested in this little company called Instacart, and now it's worth like $50 billion. So it did turn out somebody was right, but I don't know how you'd know that Semel Shah at Haystack was right.
Yeah, and there's always exceptions, but I just, in my bones feel like we just need to be more patient.
I'm going to close this out in about 10 seconds, and we have 34 people that have voted, and it's very close. So your vote can count. Your vote can count here, all right? All right? All right? But we will close this out
I was
soon.
going to offer free drinks, but you already beat me to it.
We do have that open bar. And anybody who's coming in right now, we got some seats over here and in the back. Feel free to come over. It looks like it's not moving. It looks like Jenny has taken the first round. So Jenny, clap it. There you go. Clap it up for Jenny. Congratulations. Good job. Let's move into question 2. This question comes from Entra, that network of entrepreneurs. Mike Morrow just walked into. I don't know where Mike went. But Mike, there you go. Anyways, this is a question from a founder. I'm an early stage startup. Should I raise with a safe or convertible note? If I choose a safe, should I raise on a pre or post money valuation? And feel free to educate us on this as we go through this. And Yash, kick it off.
Sure, thanks, Charlie. Honestly, for most founders, it does not matter. And that is the straight truth. Like, I can educate you, but you can Google this. It's pretty straightforward. Pre-money safes are most founder-friendly. Post-money safes are more investor-friendly. Convertible notes can be really weird, and very few people do them now. High level, if half of your round is coming from an investor and they want a post-money safe, just take the money and get back to work. Like, that's your whole thing at pre-seed and seed. Don't worry about it, is my short answer. Don't optimize for 1 or 2% of dilution. Really spend your time thinking whether this investor is aligned well with what you're building, and that's what you should be focused on, and talking to your customers.
Yash with the meat and potatoes answer. I like that. Right to the point. Jenny, what do you think here? Safe, convertible note?
I mean, I don't have much to add. I think that was quite complete. I mean, the only thing I would say is, like, know your ecosystem, because, what you said is that notes aren't very common, but if you're raising in Europe or places where safes are not common, you just have to be kind of, cognizant of what the local ecosystem is. So I'd say, just know your customer. And just as he mentioned, like, it's such a shit show out there raising money, so anyone will give you anything. They're going to write you a napkin, like, IOU, like, literally take it.
Erica? Open for debate too,
Yeah, well, I think it's a really simple question. I mean, I agree that the convertible note can be more difficult. It's generally more expensive to execute than a safe. So a safe more accurately reflects what you're actually issuing, right? Which is something that should eventually become equity. If I were a founder, I'd probably do it on a pre-money safe rather than a post-money, because you're likely to keep raising on the safe and to probably need to raise more than what you initially targeted. So from your perspective, that's less dilution. But I do think, they're all really great options. Just make sure you understand the difference between pre and post.
Erica, thank you for dropping the gems. Paul?
I can't disagree more with everybody. Only ever do it as a post-money. I can't tell you the number of times I've been in a deal where the actual calculation was incorrect, either by the fund themselves, the next round investor, or the CEO, because the pre-computations suck, and they're also they're full ratchet. So everyone's worried about down rounds and anti-dilution. Guess what? Your safes are full ratchet in the pre-money. This really, really sucks for you as a founder. If you do it post, the math works always. We had a deal years ago that Bessemer led the follow-on round. They issued a term sheet of a $30 million post, and the guy from Bessemer calls me up. He says, look, I signed the term sheet, but it turns out it's really a $50 million round. I'm sorry, I'm off by $20 million. Should I stand by my term sheet? I said, yeah, you issued it, so you're going to stick with it. They owned 40% less of that company because Bessemer got the math wrong. So don't get in a spot where Bessemer can get their math wrong, and that happens when you do it in the pre. 100% of the time, post money, the math is way, way easier.
I mean, get a good lawyer. I
Yeah.
mean,
They get it wrong.
Also,
Bessemer's
people
lawyer
are just
literally had it
Like,
wrong.
I agree with
need-
you absolutely for later stage rounds, but the truth is most founders who are doing an early stage round will keep raising on that same instrument.
Right now
so
in this
if you're going to
environment-
do that on a post, you're fucking yourself. Sorry,
Yeah.
excuse my French.
I mean, it can be messy, but right now, everyone, I don't know any founder who's not taking a little bit more on their last note, and so.
Yeah, if you're
But
picking
totally
up-
Stack
agreed
the
for
posts.
later stage rounds where you're not expecting, if you're raising $20 million, you're in a different stratosphere as far as structuring. You should probably just be doing priced equity.
Yeah, absolutely agree with that. If you're doing a Series A, do price. But if you're pre-seed picking up 100K angel checks, do it on a pre.
This is what we're here for, the debate, okay? This is good stuff. Slido is going to open up. As we do Slido, by a show of hands, how many founders do we have in the audience? There we go. And I guess show of hands, how many founders are raising right now or looking at it? There we go. Good. All right, and let's get these
I
votes
will
in.
say the investors are going to push you to do post, and in this environment, you're not necessarily going to have much leverage. So most of you will end up doing post, as per Paul, but if you can get the pre.
Yeah, we're letting you guys know what's best for you. So this is insider information.
Trust me, it's best for you. Math wrong is not good for anybody.
Get Carta.
We're going to try to get to like 45 or so, and I think I'll cut it off at 45. That might make sense, at least for this one. Also, show of hands in the crowd, investors. Any investors in the crowd? We got some? Alligator arms. There we go.
And by the way, I'm
They don't want
glad
to
you're not on
identify
the
themselves.
I saw that jacket. I was like, shit, I hope he's not on the panel because I was kind of intimidated by that
Gotta
jacket.
get him up.
I was like, dude, I don't want any part of that.
And Dina, we have to give a shout out to Dina. Dina, come on, raise your hand over here. She's New York Ventures. She was with First Republic. She's now New York Ventures. She's helping with the post open bar pregame. We're going to close this out. It looks like Paul has taken this round. Way to go against the grain, Paul, and take the round. So Jenny and Paul taking the round. What I will say, when we get to the finals, it's a cumulative score. So it's not just a 1 point. So
The founders voting against their best interest. This is like, this guy is good. Watch out
Wow,
for
yeah,
him. He runs
dangerous,
a venture
right,
fund.
right.
Okay.
8-time founder myself, just
okay.
FYI.
So we got another founder-focused question here for the third question. Outside crazy growth numbers, what's the most unique, or what is something unique that has a big impact when reviewing a pitch deck? Jenny, why don't you start us off here?
I mean, I'm always the first check-in, so it has to be the team slide. I want to see a picture, understand what you've built before, not what school you went to, and just something that kind of impresses me that you're the one to build this company.
Yash.
Thanks, Charlie. If you put a TLDR on your first or second slide, I will love you forever. Tell me team, traction, deck, and terms of the fundraise, right? Just tell me that right off the bat, and I will love you. Then you can tell me about Josie, the software engineer who has to do 40 hours of manual data entry every week, right? Like, you can dive into that, but give me the meat right up front, and I will love you forever.
Okay. Paul, what do you think in reviewing a deck? Something unique that you look for?
Look, it's always a function of what stage you're at. The thing I always care about is go-to-market. I kind of don't care how awesome your product is, even though you want to spend 30 slides on how awesome your product is. If you can't tell me how you're going to get it in the hands of people, it literally doesn't matter. And so I will occasionally really butt heads with what I would describe as CEO founders who actually don't want to be the CEO. They want to be the VP of product. I'm like, cool, this is awesome. I love what you're doing. You can be the VP of product now. Can you show me who the CEO is in the room? And I know that sounds like, oh, wow, you're being rough on them, but it is. Like, as I said, I'm an 8-time founder, and when I start a company, it's not just about the product, it's about what I'm going to do with it, and who I'm going to excite with it, and how I'm going to get there. And I know even in an early stage deck, and I know this is an early stage group and largely early stage investors, which I am as well, do yourself a favor. Put some stuff in there about how you get it in the hands of other people, and take 1 or 2 of your product slides out.
Okay. Erica, what are you thinking here?
Yeah, so my secret sauce isn't a slide, okay? It's actually what you're saying at the very beginning of the presentation. I think it's so important in the first 5 seconds not to say, hi, we're McAfee and we're an enterprise software solution for distributed verticals of crypto, something that's going to put your investors right to sleep. But you really want to start off describing the pain point, right? You want to actually make the person feel the pain of your customer and get so excited by your solution. So make sure that you tell a story that resonates. If when people people aren't hearing you talk about the problem that you're solving, they don't feel something inside, it's going to be really hard for you to raise money, and it's going to be really hard for you to sell the product. So make sure that you focus on that feeling, that vibration, and not, as Paul said, describing all the features, all the details of the product right off the bat.
I couldn't agree more, by the way. I always love when the founder starts with, why are you here? Like, what made you decide to do this thing? Because that is actually pretty important to the story. Like, you're going to come in and pitch. I remember Jack Pocket. Do you guys know Pete Sullivan, who sells lottery tickets here in New York? Remember,
Definitely
he walks
know
in
him.
and like, you'd confuse him for the security guard, like, in the corner. And he walks in, he's like, yo, dude, I sell lottery tickets. I'm like, so tell me why. He's like, my dad bought the lottery tickets religiously. He was a cop in town. I wanted to make it easier for him. And immediately, I'm just like, I'm totally into this pitch right away because
But
I
that's
connected.
team. That's not go to market, as you said.
So I'm saying-
That's exactly what
No,
I
he's
want to
saying-
know.
he's saying
I
my
wanna
answer was
know
right.
Team.
That's right. That's right. I give some of my points over to you because I'm agreeing with
Thanks,
you.
Paul.
Because when I get to the slides, I want to see slides on go-to-market, but I want you to say what you just said before you start with your slides so I know why you're in my office.
100%.
To be fair, though, you're getting to the pitch after looking at the deck for a while, and then you've agreed to take the call, and then take the meeting, then you're taking the pitch. So I would say in the deck itself, just put a TLDR on the front page, please.
What's TLDR? No, I'm just kidding.
Too long,
Too
did
long,
not read.
didn't read.
Let's open up the Slido. Voting. Do we have any disagreements here? I like the disagreements. Just give me some more banter. I don't know. Have we missed anything here? Paul is just staring at that.
See what happens when I give you points? That's what I'm
Right.
talking
Love
about.
it.
Paul's giving
Thank
away
you,
points.
Paul.
Next,
Thank you.
next
credit
round,
for
I
the
gotta
points.
go after her. I gotta go attack her in the next round.
Oh, okay. I love this.
It looks like
Jenny.
Erica's taking this and
Talking about good work.
up to 40. So I think we're going to give that to Erica. Good job, Erica.
Anybody's
Look at that.
game here.
Well-balanced competition tonight. I like that. Reminder, this is the last question before we get into cuts. And when the two VCs are cut, they're going to move to the outside, and the two winners will go into the middle. So that's what we're going to do. I don't want to hurt anyone's feelings, but I want to put that out there right now. And I'll let you debate even longer for this last question, which is a nice little fun question before we get into the finals. It seems nowadays that no one knows the true definition of a recession. Ooh, hot topic. What is your definition of a recession, and how does one affect your investment approach? Paul, definition of recession, and how does it affect your approach?
So my partner Duncan has a saying. A recession is when your neighbor loses his job, and depression is when you lose your job. And so there is a lot of wisdom to this, though, right now, because we're in this totally uncharted part of the world where unemployment is like low and dropping, but yet everything costs twice as much as it did the year before. This is literally, basically, we've never been through this before. So the thing I'm really paying attention to is at some point the shoe has to drop on unemployment. And so until we're in a spot where people are losing their jobs, I don't know that I agree with the administration arbitrarily deciding that's not the definition anymore on GDP. That's just bullshit. But them saying it's different this time because of the unemployment numbers is true. And I mean, look around. How many of you are having trouble getting a job right now? It is one of the best job markets we've had in a long time still, but at some point the shoe has to drop. That's the thing I'd be waiting for. That's the point at which I'll actually get worried. But right now, with everybody having a job, just make sure you don't have too many miles to drive in your car.
Jenny, what are you thinking here?
Not an economist, so can't comment on the first part, but I'll comment on the second, which is how is it impacting the way I think of it and think of my job. And I'd say not impacting us. We are long-term investors. We're pre-seed investors, which means you're probably not going to have any type of realization for, 10 years. So hopefully we're out of this downward cycle by then. Again, if you're building a business for the future, I'm not worried about today.
Okay, Erica.
Yeah, so traditional definition is 2/4 of GDP decline. So that's, sort of how it's actually measured. But what I think really matters more is people's outlook, right? It's like, how do the people around you feel about spending money, about buying things, about making investments? And a lot of that does have to do with employment and whether or not you feel you have job security. We're in a really scary time right now. I have a portfolio company that just did a $30 million raise, actually $40 million raise, and they're still laying people off because the entire environment is contracting. And all of that stuff hasn't really funneled through the system yet. So it remains to be seen. The other big issue is that with inflation, nearing double digits, everyone is more terrified than ever around, what the future holds and what they can purchase. I've seen rents go up in New York City an astronomical amount. We're all paying more for the basic fixed expenses. So to me, those are really the most important indicators of a recession. How comfortable do people feel spending money and how confident they feel in their future? As far as how it actually affects our investment philosophy, it doesn't affect our deployment of capital, but what it does let us do is invest on better terms. You've probably seen that over the last 10 years, everything has gone way towards being extremely founder-friendly. Valuations have been insane. Everybody thinks that they already have a unicorn. I mean, I know companies with barely a few $1 million in revenue that raised at $1 billion valuations last year and are rushing to go out of business this year in a matter of months. So we haven't even yet seen the true fallout of this recession. And, hopefully it's not going to be as bad as people think.
Yash, finish strong here. What do you got?
Actually, I will leave the definitions to the spin doctors in the White House. I do not care. I am looking at, and the economists. I'm looking at public market valuations. They're coming down. That has ripple effects downstream. That has implications for companies in our portfolio that are looking to raise the next round. So in our day-to-day activities, you're managing reserves a little more carefully, right? But I do agree that we're early stage investors. We invest at pre-seed and seed stages. We've always historically invested in very disciplined founders who are building businesses along with their products, and I think that's important to do from the ground up, and we've always done that. And if this stays the way it's going for the next 10 years, we're all screwed, so I'm not too worried about that.
Yeah, and I'll go off topic a little bit because I do want to talk about valuations, although I don't know if anyone here cares about it, but I do, and it's fun, is that public market valuations in fintech and other tech-heavy SaaS sectors, have sometimes sold off by 90%. And all these VCs are marking their portfolios, at cost, right? Like it takes a long time before VCs actually mark down their portfolios. So, I think it's going to be really interesting once you see people actually having to mark things down and how that affects accessibility to capital for all the startups in the market.
But there's one other lag that's actually really important for this audience to follow too, which is how much money's in the ground. So go into PitchBook and look at how much venture capital was raised by quarter. It takes people like us 3 to 5 years to deploy that money. And so if that money keeps going into the ground, yes, the market drops in valuation, it's a little bit harder, but it's only once our money dries up that good companies don't get bids. I don't mind if you're a good company and you get a bid at half the price. I know that might sound bad, but ultimately the exit value of the company is long in the future, as long as the good companies can raise. But really sucks is when you get into a market like we had in 2001, 2, and 3, where high quality companies could not raise because there wasn't enough money in the hands of us people to give it to you. So pay attention to how much capital's there. There's a 2 to 3 year lag. And if we get out of this before that lag catches up, you will only be, in my opinion, annoyed, not completely crucified, which can happen if it goes longer.
I don't believe that things are really bad. So I love you, Erica, but I don't really agree with that. I think we're in this crazy tech, we're all in our own bubble, but most of my friends are doctors and bartenders and artists, and honestly, they have had no change in their mentality, their lifestyle, or anything. So I think we're living in, a bubble, and the tech world is, definitely having a moment, but I don't feel like a lot of people that I know.
A cocktail with a friend of mine last night who said that her rent went up by $2,000. So yeah, she felt that.
But she probably is getting more money as well because many people are because there's the unemployment.
That's an optimistic way to look at it.
Unemployment is so low. Yeah. So I do feel
go.
I do feel like we are not in this crazy, like there's so much hype about how things are bad that we've convinced ourselves that things are bad, and so VCs are like, oh, we got to pull back, but like, why?
Well,
people are spending.
so I'll just say one thing that structurally is unavoidable, right? So we raise money from institutions. Institutions have specific asset allocation, right? Let's say they're saying, okay, we can only allocate 15% of our total portfolio to venture. When the public market valuations go down, they're now underrated in their public market securities and they're overweighted in venture, which means less money flowing into funds like ours and less money flowing to founders like you. So it takes a little while to catch up, but the impact will be felt, at the startup level.
Well, we'll be out of it by then, by the time
Okay.
you're raising your next fund, because she
Yay,
just closed an
Jenny.
amazing amount of money this year, so you're golden.
That's true.
And to be fair, a lot of early stage funds raised a lot of money in the last 2 years. So if you are raising a pre-seed or a seed stage round this year and you're building a good business, I wouldn't worry about it too much.
All right, that was a good round. I like that. Let's open up the Slido. Again, we're going to have the percentage of Slido. Tyler, correct
I
me
think
if
we
I'm
should
wrong.
all just fight this out.
Yeah,
like
I mean, that's the
boxing
point, right?
gloves
Let's get this going.
There's a belt. Can we use our fists?
So this is for question 4. This is not for the finals, if I'm correct. And I believe Tyler is going to do some sort of math, or Slido is.
Thanks,
Technology is nice. Very nice. So we'll get up to 40 or so, and then I believe Nadal will show us the final results. But it looks like Erica, it looks like you're
Sweet.
taking this round,
Great,
which,
this means I get to
which
work
is nice.
more.
Which is nice. You might have to take Yash's spot there. Nadal, can you show the overall results? I believe you can, but I don't know. This is math. All right. Anyone got a question in the crowd? Here we go.
Hi, my name is MJ. I'm founder of Only You Skincare. I just celebrated my 2nd year anniversary for my company.
Congrats.
Thank you. I've also just graduated Goldman Sachs Women in Black Women. So this upcoming fall, I want to start my first round of raising capital. What instruments would you guys suggest for that? Because I know there's crowdfunding, there's also fundraising events. What are some things that I should do as like my first time?
Did you see me on the panel at the Goldman Sachs thing? Yeah, good to see you again, MJ. Congratulations. I love that you're, so you said it's a skincare company. That's great. So
She has samples, too, if anybody wants some.
It's medicinal, so it's the first vegan, steroid-free cream for eczema in children.
Oh, that's awesome. My daughter suffered really badly from eczema, so you'll have to give me a little. Yeah, you did give me a sample. You know what? I don't think she got. Give me another one so she can actually try it out. So I hear people on the crowdfunding thing. I've never really been a fan of it because I think it's really disruptive to a cap table, and I also think that you're much better off to have like capital partners who are people who really have a vested interest in your company and experience, starting and running businesses that can help you. I actually know quite a few, exited consumer founders. We should connect after. I'm happy to make some introductions for you for people who invest specifically in the space. One of the things that folks don't realize about crowdfunding is that, it's just as hard to probably raise $100 on a crowdfunding site and cost just as much as it is to sell $100 worth of product. So I'd way rather see you selling $100 worth of product and putting your efforts there than going on a crowdfunding campaign and actually seeing if you can get capital from, usually what people will do initially is what we call sort of like a friends and family round. And you can certainly use that Goldman network to tap into raising money from sort of high net worth individuals. And people usually do that for about their first up to $250,000 in capital raise. They raise from people who actually know them. And the reason that that's important is that usually before a professional investor wants to put a check into your company, they want to know that you've raised money from people who really know you well and are willing to bet on you. And hopefully some people who maybe you're going to have to see at Thanksgiving and explain to them, how the business is going and what you did with the money. So there are a lot of reasons for doing a friends and family round, but however large that's going to be for you, I would definitely, especially with consumer products, look for people who have experience in the space to be capital partners, because if your business is successful, you're probably going to need a lot more capital to scale it.
We have the results. And in the finals is Erica. Congratulations, Erica. So you're gonna switch with Yash. Yash, you didn't make the finals. I apologize, but that's what's going on. Watch those waters. Very dangerous. And who else made the finals but Paul? Paul. So Jenny was a close third there. And Paul, you are in the hot seat in the finals. And we are getting closer to happy hour open bar at the Smithfield, First Republic. All right.
Let's go.
All right.
Alcohol here.
I know, right?
It would be way better.
Any trash talk before we get started, you two?
What kind of booze do you like?
Everyone here has made a mistake.
Tequila and white wine.
Yeah, tequila. No, just shots. Yeah.
Shots.
We're in.
Shots at the
We're in.
bar.
This is
no trash
dangerous.
talking, just drinking.
All right.
I'm gonna drink
See
you
where
under the
this
table.
night
Let's
leads
go.
us.
Let's go. Yeah.
All right,
Yeah,
here's
Plaza
a-
Azul. Let's go.
Here's a tweet coming from the VC Twitterverse. So this is from a VC. And this statement is, founders need to be cognizant of the dynamics at play when an investor in a round is only getting a fraction of their target ownership. Post-round, that investor's primary incentive is to buy up their target ownership to a favorable price, not to maximize company value. Do you agree or disagree with this statement? Erica, why don't you start us up?
Yeah, sure. Well, I think that target ownership is important, and it's something that we certainly think about when we make an investment because we want to be sure that we're going to be adequately compensated for all the work that we're doing with the company. I think it would be highly unethical to imagine that a VC that you partner with is somehow going to try to artificially deflate the valuation of your company to acquire more equity. But certainly there is a dynamic there, right? Which is that, when we acquire a bit of equity early, what we want to see is, let's say we do a moderately priced pre-seed round, and then we want to keep our seed round also, at a reasonable price, right? And bring in new investors and to be able to actually acquire that equity over time. But I don't think VCs are ever purposely trying to deflate the valuation of a company because they, not only do they have to buy the equity, but they're also holding it in the portfolio. So I don't necessarily agree that it's something you have to be tremendously worried about. I do think it's a great idea actually to have somewhat multi-stage venture funds at the early stage that can come in, do that sort of, smaller seed, do that A, and maybe also help you out with that B. And when everybody can stay in the round and keep the prices reasonable, it works out well for the investors and the founders.
Paul, you agree?
So I read the question differently. So my view here is that when people like us talk about ownership, we're kind of on your team. We're trying to tell you, look, I got to get to 10 or 12 points. This is about when someone like SoftBank with $20 billion decides to buy 2% of your company and throws in this explorer bullshit check. And then every other investor goes and calls SoftBank and says, SoftBank, why aren't you leading the next round? And you're totally screwed because they bought a free option on your company off your back. Don't do that. Don't let the big funds buy 1/10 of what it is they'd want to buy. Now, if I'm getting 8% or 12% or 14%, I totally agree with all of that. But don't let that fund come in for 2 points when they're going to try and get up to 20 points and basically screw you by signaling downstream. I think that's how I read this, and I would highly advise you to avoid those kinds of investors because they just screw you up.
I read it a little bit differently, but I would totally agree with the part. Be very careful about taking money from these sort of whale funds that are just lobbing money in at crazy valuations that can actually be really dangerous for founders. I can already think of a couple of companies that raised money from SoftBank over the last 12 months on insane valuations that are probably going to be in a world of hurt over the next year.
And anytime I get to make fun of SoftBank, I try. That's like
Awesome.
that's like my thing.
I'll do that with
it's
you.
It's kind of like
And
my
Tiger Global.
little Easter egg you might catch.
Matsu-san. All right. Anything that stood out there from the gallery up here? I mean, if you want to jump in with any, I don't want to. All right. Well, let's move on to the next question. What is a tactic the smartest founders are utilizing when raising capital? Paul, start this one off, please.
Do you remember that movie, Glengarry Glen Ross, Always Be Closing? The best founders are constantly raising money. And I know that runs against what you want to do because you want to get back to go build your product, et cetera. But the best founders get over on people like us by basically rolling their clothes, by hitting more milestones and pumping up the price. And so instead of thinking of each fundraise as this monolithic thing that you gear up for every 2 years, hey, I'm going to take a little bit of money, I'm going to hit this milestone, I'm going to get 6 months in. Yes, you're taking more risk on your end, but I find that the repeat founders, including this guy right up here who I've been involved with a bunch of times, are really, really smart when they do the rolling close the whole way through. At some point, it all gets collapsed down into a bigger round, and then you're playing a different game. But I really enjoy when I see a founder who basically has figured out a way to get over on me. That, high praise from me.
That's great. Well, so I definitely believe in the always be closing strategy. I'm always fundraising, right? So that's really important. But as far as tactics, my favorite tactic that I've ever seen for both fundraising as well as just a really cool marketing strategy is just start a podcast, right? So start your own podcast, and then those people that you want to get in touch with, that you want to invest in you, that you want to buy your product, have them on as a guest. If you're not able to get their attention, right, through an email or get them to set up a Zoom for you, it's a totally different thing to say, hey, guess what? You know, I'd love for you to be on my podcast. It's 30 minutes of your time. And it's a wonderful opportunity to stroke their ego, make them feel great about themselves, and actually get in front of them for 30 minutes and learn something about them. So instead of pitching their product, you know, your product to them or your company to them, you're letting them pitch you. You're getting all the inside information on what they care about, you know, what matters to them, how you can actually sell them better. And I've seen this tactic used brilliantly, not only to raise money, but in enterprise sales to get to those decision makers that you need to back you.
And then the best part is you invite the people on your podcast to be on your customer advisory council, and you give them a little bit of stock, and then they bring in all your other customers for you. That's super cool when you do that.
Super cool.
Before we move on to the final question, Jenny or Yash, do you have any tactics you'd like to share real quick? Some of the smartest tactics raising capital.
I do kind of disagree a little bit with always be closing. I think there is something to be said about a gated process. If you're past a seed, right, then being mindful of your time. Yeah. I think if you're raising a pre-seed, always be raising, send out investor updates, hit those milestones, get higher and higher caps, but past a seed, get a little disciplined about your process. Run a tight one.
Well, I just want to be clear. I don't think we mean always be taking in capital, but always be raising, right? So, you know, you don't have to necessarily be taking a check of, you know, a small amount, but you always want to be selling those investors and saying, hey, you know what? Great. We're working on you for our next round. We're going to let you know when it's open. Technically, you should have all of your indications of interest in place before you even open the round.
Jenny, you want to chime in here? No? All right. Okay. All right, so final and last question. What's an unpopular investment sector that you like that no one else does? And Erica, kick it off for the final question, and then we'll open up the slide after Paul.
Great. Well, you know, I'm not sure about unpopular, but I'm actually warming up to health tech investments. I think for a long time we were staying away from health tech investments, you know, with a 40-foot pole, just because it's so hard to sell technology to physicians, to hospital systems, getting through the insurance process. But I think COVID really changed things dramatically for that space. All of a sudden, there's so much more acceptance of technology. People are actually upgrading software. We've got telemedicine really taking off. And, you know, people are really looking for digital products, too, to educate physicians on how to better care for their clients. We're actually looking at a company right now, which is really exciting in the health tech space, that is working on creating cultural education for physicians so that they can better service patients that are of other races and cultures and backgrounds than they are, which is really exciting, and using technology to do that. And we've actually seen tremendous interest from both hospital systems and insurance companies about actually integrating technology to do their businesses better. And I feel like we haven't seen that in a long time. So we're willing to actually be bullish on that sector now.
Paul?
Oh, this one's easy. I mean, the category that is got to be it. It's got to be game shows featuring venture capitalists. I mean,
Right.
that's definitely,
Yeah, there we go.
that is the category.
We are
I've been
raising
looking for
capital, too.
investments
It's crazy.
there wherever I can.
Wait,
But-
what's the post money on your safe, Charlie?
Right,
Just
exactly.
get the
That's what I'm
checks
talking
out.
about. That's what I'm talking about. But other than that, except for ad tech, I mean, some of you guys in the audience do know what we do. All we do at Bullpen are categories everybody hates. That's literally what we do. When this husband and wife from Edinburgh, Scotland showed up and said, we're doing fantasy sports, that was FanDuel, we're like, yes, you got 77 no's from other venture funds. We'll be the one fund dumb enough to do it. 8 million in, 14 billion out. We like that. The more that everybody says to you, that is a dumb idea, that is a dumb category, and they'll do it in a more polite way than that, right? They're not all from Philly like me, but they'll give you the
F around
hint,
and find out, right?
right? They'll give you that hint that that's actually what they mean. I really like when the founder comes into our office and says, look, I'm in a category everybody hates, but I know I'm right. Like, I don't know what that category will be, but I know where it probably is hanging out right now. Anything that's NFT Bitcoin related, where people are like hacking them and stealing them, I can't wait till those founders come into my office and go, everybody hates this right now, because that's when we love to jump that trough of disillusion on that Gartner chart.
There's another one I forgot about, and I believe this is a portfolio company that Jenny and I actually have in common, but I discovered that the actual most hated space in all of investing is peer-to-peer lending, and that's actually our largest holding. So I'm certainly hoping that the contrarian
Super cool.
approach
Are you in
is
on
going to
deck?
work
My
on
partner's
that.
in on deck.
No, it's
he
not
loved
on
that
deck.
one. He loved that one. Yeah, that went well. Then we backed the founder again, so 2 times.
Nadal, open up the final vote for the winner between Erica and Paul. Suspense
guys.
is
Excited.
killing
Vote for
me.
me.
We're drinking no matter
I
what.
need that belt.
We're drinking no matter what. It's the
We are
Casa
drinking.
Azul, and they better have the good tequila there.
Yeah. Who
Oh shit! All right,
Not
okay.
for you,
We're gonna,
not for
we're gonna
you.
go somewhere else.
Not for you. Live scoring is the best right now because
love it.
I
I
think we
love
got
it.
about
Oh my God.
45 people.
Look
loser
at how-
has to do
look at how-
loser has to do 3 shots.
No. Winner has to do 3 shots. What are you talking about?
Winner has to do 5 shots.
Right. No, loser does 3. Winner does 5. I'm in. Yes. Finally, someone who understands.
It's moving. Yep. It's moving.
Oh my
I
God!
think
Look
we
at how
got.
close
Let's
this
do
is.
this. Oh my God! Is
my
it gonna be a
God.
tie? Is it
Oh
gonna
my
be a
God.
tie? Oh my God!
We had a tie last time.
Squeaking it out. Squeaking it out.
Is anyone not voting?
Yes.
I don't know.
This is unbelievable.
All right.
All right.
Whoa!
Oh, it's time.
You better
I
stop
love
it right
I
there.
think 45 is the
Gotta
number.
stop it now.
45 is the
Tie.
number.
Let's tie. I accept a tie.
I see something right here. I don't want to point it out.
There's 2 belts.
There's
two belts
one
in
more
the house.
vote.
Can we
There
move?
it is, Erica. Erica's the winner.
Whoever did that, I do not like.
Oh,
Yeah, I like that person.
I don't know what to do here.
I love you guys.
There we go. Erica again takes the lead. All right.
All right,
We're
enough,
closing
enough.
it out. We're closing it out. There we go. Erica's the winner. We got the proud
God, by
Erica
1 point.
winner again.
Thank you all so
Erica,
much.
take the stage and do your victory lap. Do your speech. Talk about whatever you want to talk about.
So what? All right.
She has
all right.
2
This-
belts. You owe her a belt. She could do 2 belts. There you go. 2 belts.
I want to thank everyone who voted and participated tonight. You guys are amazing. I want to thank Charlie and everyone at PrimeTime VC, First Republic Bank, and all of the sponsors. I can't believe that I won tonight. I'm really just so amazed and honored. You guys have made my week. And if anybody, wants to pitch me or, talk about raising money, it's Erica at Rain VC. Come hit me up at the happy hour, and I'm happy to give you my cell phone number. You can text me for an appointment.
Let's take
okay?
a quick
Woo!